Welcome to another episode of the Business Boys Bodcast. I'm Hamza, and today I'm joined by Will, Kev. In today's episode, we'll be looking at something we've probably noticed in the news for a while. I'm sure lots of people have seen it, and that is more and more bank branches disappearing from the high street. We'll explore the reasons for this by briefly tapping into the history of the financial industry and emphasizing on the 2023 profits in the banking sector, internationalization of banking services, and the truth behind why bank closures are an ongoing problem in the UK as banks continue to blame increased online banking users and the decline of in person banking. So, whatever the truth is, you'll find out. So, stay tuned to the end.
So really quickly, I think it's important where banks all came from. So historical records for banks actually date back from Greece, Rome, Egypt, and Babylon, and they suggest that religious temples were used to keep wealth safe and hand out loans to citizens. Although these temples were not as modern day banks are today, Julius Caesar began to kickstart similar rules, for example, ones that allow bankers to confiscate land when debtors couldn't pay. The roots of modern day banking could have started as early as the 12th century, though. But looking to European monarch Philip II of Spain in 1557, he actually caused the world's first national bankruptcy, as 40% of the GDP of Spain was going towards paying down debts, debt fueled from the expansion of credit, large loans for wars, and extravagance, all provided by the banks. Fast forward to today, and we see banks not only store wealth, but they facilitate transactions and provide loans, but also offer many differing services. It's important to remember that although the banks provide a valuable function, they must have the proper regulation to avoid catastrophes like those seen in the 2008 financial crisis. Here, the overexpansion of risky loans, lowering US house prices, and rising number of borrowers unable to pay their loans crippled the US economy and turned the world. After the crisis, banking share prices were slashed alongside profits. However, with interest rate rises up again in 2021, banking profits are now seeing greater headwinds.
Now, before we go into banking profits, how it's been affected due to the change in the economy, let's quickly look into how banks have been used to regulate the economy through our history. The Bank of Sweden, Sveriges Riksbank, founded in 1668, is often considered one of the world's first central banks. And these central banks were established to manage government debt, regulate money supply, and to stabilize currency value. So, in the late 19th and 20th century, they witnessed numerous banking crises and panics leading to development of the early banking system. So, in the Great Depression of 1930s, it was exposed that there are weaknesses in the global banking system, and this led to several reforms. The Glass-Steagall Act in the United States separated the commercial banking from investment banking. So this was done to avoid putting the depositors' money at risk and prevent banks from using it for speculative investments. To protect the deposits further and increase public's confidence in the banking system, deposit insurance was established, as the Federal Deposit Insurance Corporation in the United States to prevent bank runs. This is interesting because in one of our earlier podcasts, we had discussed of how Silicon Valley Bank failed because of a bank run. But how did it fail because of a bank run if the FDIC exists? This is because while the FDIC can help mitigate the effects of a bank run, it cannot stop all bank failures caused by banks. And Silicon Valley Bank was too deep in trouble to be. So, jumping back on the timeline, in 1944, post the Second World War, the Bretton Woods Conference established a new international monetary system. That was the IMF, not the Impossible Mission Force, but the International Monetary Fund, to regulate and stabilize exchange rates, provide financial assistance to countries, and promote economic development worldwide. The deregulation seen in the banking sector in the latter half of the 20th century led to the financial innovation and development of complex financial instruments, which is also what ended up causing the 2008 financial crisis. So we can see that banks have evolved from simple institutions that facilitated trade to complex financial.
That's what I was about to say. History is very simple. We just made it more complicated at this point. So, yeah, I was just thinking about how we succeeded caused the financial crisis in 2008. But our ancestors didn't. So anyway, but yeah, thank you for that input. Back to 2023. Here we are. So when you see a headline that says full list of bank closures coming in 2023 and 2024, including HSBC, Lloyds, and Barclays, and more actually, but this was the headline I captured. So what does this make you feel?
Well, it's interesting you say that, Hamza, because I actually found some data from a company called Essentia, and they say that only 3% of interactions in banks actually happen face to face now. So there's this argument that maybe we don't need the bank on the high street. But some data from Accenture as well says that 27% of consumers would much prefer to go into the bank if they were doing a large transaction. They'd like to see someone face to face. And I thought that was interesting because it sounds like, you know, when you are sending large amounts, you want to see one accountability. Like I was sending an account and I just did it all online, and I was a little bit nervous. I was like, oh my God, like what if I'm just sending this to some random place, some different country? So
I think there is a limit, first of all, to how much you can transfer online. So I think there's like, if it's quite a high amount or like purchasing thing that's quite big, then I think it requires being in person. So I think this is what I'm just a bit confused, on why, or not what the reason is, but I guess on the usefulness of it. It is quite useful to some extent because, for example, for me, whenever I had to transfer something like 1,000 or so, it would just be easy to do it online. But the problem is that the banks do restrict once you go over a certain amount, and then they tell you that you actually can't do it online and that you have to come to us. So I guess that is something to keep in mind when, deciding on these things. But at the same time, I don't know if the future banks will probably, like online banking or those sort of things, will actually be more flexible and allow this to happen. But this could also increase fraud.
I get what you. I also think that the amount of money transfer transaction kind of depends on the nature of the account you have at the bank. And if
history, done a load of big transactions, it would look as weird.
yes, exactly. So if you are a person who probably doesn't have a lot of big transactions happening with your banks, then that's when they might, it might be red flags to the bank when have such a big transaction come out all of a sudden. But if you are a businessman, probably has big transactions happening through their banks all the time, I'm pretty sure they might facilitate that transaction. Used to it. And like when Will said that 23% prefer to have that experience.
I think 27% when opening a new product or doing a large transaction, they would prefer to do it in branch.
27% be corporate clients, or would they just be individual, or a mix?
General public, and I think it's because people associate more risk. Big transaction. Essentially, the risk that they'd have losing the money would be same if they were doing an online transaction for say £100 or say £5,000. Risk would be the same, but since the money is more, people automatically associate risk with the £5,000. And even though we have seen a lot of changes in people's perceptions of online banking, change from 2000s to say right now, people were more risk averse, and they wouldn't trust online banking, let's say back then, but now they are more trusting. But still, we can see that people are not. Their risk appetite is less when it comes to higher amounts of money, and they prefer to have some kind of a security. Right, that's probably why they go to the banks.
The thing is, Hamza, I don't know if you want to say, are you pro branches? What would you like? Do you want there to be more branches? Because I've got another stat from Accenture here, and they say in 2019, banks worldwide spent more than $650 billion maintaining their branch networks by their analysis. $650 billion from having the branches. So we can see there's a massive financial incentive to get rid of the branches and go fully online.
Okay, I'm not gonna rant or anything, but I just think that banks have this big base that they use for I don't know what. So, like, if you just look at HSBC here, it's amazing. It looks beautiful, but I just think that what they're looking for isn't actually like, okay, you can just. I understand that now all clients are coming into their places, but if they do decide to move online and at the same time accommodate a few people who do want to come to them, then they don't necessarily need this space. And I still have no idea why this space is here to start with, because I get it, there are lots of people coming in, but there still is a waste of space. Plus, if you're looking to transfer high amounts of money, so corporate clients, for example, they do have a floor, a specific level for that. HSBC here, for example, has like the ground floor is for clients like us individuals, and then the top floor is for corporates. So and it's quite big. So I just think that it makes sense why it's expensive.
Why they might have such a high expenditure in maintaining their branches, because having a branch also means it's not just conducting financial transactions. They have to store money there. They have to transport that money in cash from one branch to another, and some banks even provide safety deposit features. So they need a locker, accommodate space, and they accommodate space for that security for that. And spending money on several of these branches to security, to have staff around all the time. I see why these expenses are incurred, and I think it will be good. Of course, it is good for the bank to cut down on this expenditure. But if you were to ask me what my stance is, I would yes, like probably better that banks that many branches. Like, it's not like I haven't been to a bank. I've been in the UK. I've got my account online. I opened my account online. I did everything online, and I don't see. I feel like it might be a waste of. I also see how it might end up in a lot of people maybe jobs, maybe like bank tellers who are employed worldwide. They might end up jobs. So that is the downside of this. But then again, these are probably resources that banks can direct elsewhere.
It is said that around 54 branches close every month. So
is that worldwide or
no, in the UK? Yeah, with more scheduled as we go into 2024. So these are estimates, and I know people might be questioning some of these estimates, but these estimates are the reason I say that they're estimates is because different articles say slightly different figures, but let's just say that it's around this. So Lloyd's is closing at least 107 banks this year and into 2024. NatWest is 140. Barclays is 156 in 2023 and 24. Halifax 62 and Santander 5. So that forms a total of 636 closing banks and 424 shut so far. Yeah. With another 42 added into the list of 2024. So as you can see, the situation is quite obvious, yeah. But here's a question: why are more than 1 in 8 UK branches closing if they just opened at the start of 3? So this is why I've been questioning myself. They've dedicated a specific amount of investment into this, but then they decide to just close.
it could have been COVID. I mean, we saw that this explosion of kind of economic activity and industry, and now that we've had rising interest rates and a bit of a recessionary period, that could be contracting again.
See, that's what most people think. Most people think that it started from
Have I fallen into your trap?
But it's actually been ongoing since 2015. So banks are now putting the blame on the people's movement towards online banking, and obviously decline in in-person banking. And although this may be true to some extent, the Financial Times does have a more radical explanation. So they're saying that the closures underline the growth. So sparsity. So rephrase it. The closures underline the growing sparsity of cash infrastructure across the country. So obviously we know that COVID could have been another explanation for that. Despite the government's proposal last month, and this article was, I believe, in September, published in September, to ensure long-term access to cash. So adding to this, Sam Richardson is a deputy editor of consumer rights magazine Which Money, and he said that a closed bank branch does not mean one less place to withdraw or deposit cash locally, but it also makes access to face-to-face banking services harder. So, and if we're now tracing this sparsity of cash infrastructure across the country back to 2015 in January, we can see that the problem started since, with 5,600 bank branches shutting its doors. So obviously we're seeing now like a few bank closures and stuff, and it is quite significant, but it's been going for a long period of time. So it's good to look into that. So if we look into financial tech companies like Revolut, Monzo, and others, I'm not exactly sure when Monzo was founded.
Monzo's 2015 as well.
15. They're both in 20. Okay. So yeah, if we look to online banking and into the financial tech companies, Revolut and Monzo were kind of like the revolutionary online banking service. So that could be one of the reasons why this caused, banking branch closures in the future and up until now. But now if we're also looking into AI, because it's one of the hot topics, according to S&P Global, banks are now starting to incorporate generative AI into their systems, and this will make the shift even more dramatic into online banking. And
how do you mean they are incorporating?
So how do they do this? That was your question. So by adopting this technology, generative AI promises earning growth, improvements to decision making. So it does help them with risk management as well. So it does replace a few human, roles, but and it also does come to its own challenges, risks, and concerns and costs as well that the banks will have to manage. But it's part of the development. It is currently in its trial phases, but we should expect to see in the future that more people will be looking into this and less people will be going to physical banks.
Yeah, Hamza, I think it's important to talk about all the profits and headwinds that banks are seeing in 2023. Because I know we've got these store closures, but they need to get the profits from somewhere. And if we get number 5, a lot of these articles are going to be from McKinsey report. But the past 18 months brought banks their highest highs and lowest lows. So we can see to the far right of the graph, number 5, we can see that banks have got record return on equity in the last 10 years, up 9%. So you can see the graph is fairly negative. So the banking sector was not a good one to be in for stocks and shares or in general, but banks are now actually starting to return some equity, which is great if you're an investor in banks. We go to number 6. We can see the global banking net income year on year on the right here, and the revenue/assets for global banking, and we're both seeing positive upwards trends, both of those. And yeah, when we look at mirror number 7, we can see that the earnings per share for all banks on a compound average growth rate, looking on the x-axis at the bottom, we can see all banks are seeing growth in earnings per share. Some dips in P ratio of some of these banks, but in general, they're all seeing increases in earnings per share, which is really great for the industry. But where are these profits coming from? I think that's an interesting question. So if we look at mirror number 8, we can see that a lot of the banking profits seem to be coming from Asia and parts of Africa. In particular, Vietnam, 12% compound annual growth rate in terms of revenue. over the last 9 years. Philippines 10%, Tanzania in Africa 11%. And these are some of the hottest areas in terms of the globe, in terms of banking, revenue, profits, and growth. So I found that really interesting, that these regions are the ones doing the best for banks.
Interesting that they're given the chance. I mean, they're able to do this. So is there a reason why they're achieving this? I mean, these figures?
Yeah, it could be to do with a lot of developing economies, like India, for example. 10%. India is a massive developing economy at the moment, and there could be all kinds of ramifications. Like if we look at ESG principles, a lot of the Western countries are having to take a lead on that, which could be allowing countries like Vietnam, which typically haven't been known for their banking sectors, to catch back up in a way.
There'd also be the fact that a lot of booming increase in middle class of increase in when there's an increase in cost, that means they might end up taking more credit, and because their spendings will increase, might take up more credit. That could also.
And I also think part of this could be better education. So maybe people leaving their countries to the West and then learning from them and coming back and actually implementing this in their own country, which could be one of the reasons for a better performing bank. I mean, maybe not necessarily banks, I guess. It could be in any industry, but, because we're now looking into banks, it kind of makes sense.
So looking at the economies that have been around or more stable and stronger for longer, China and Japan, we can see they're just 2% and 5% revenue growth. So it does seem to be more these developing economies.
So going back to the present and obviously the future. So if we just talk a little about AI in banking, banks have been using traditional AI for years, actually. And that is interesting because lots of people probably don't know that. But they've used this for data classification and process automation, and they've also used it for uncovering hidden patterns and predicting events as well, so probabilities. But the difference between generative AI and traditional AI is that they are now using it. Obviously, it's improved and developed by making this AI smarter. So it will be able to now predict risks, not only probabilities of something happening. So the risk that of making a particular decision, or investing in something. So one benefit of generative AI is that it will help banks innovate in the future. So within the next 5 years, for example, banks will be able to analyze to what extent it makes economic and business changes, and to be able to invest. To be able to know how much to invest in more transformational AI strategies. So it's like AI helps banks search for more AI.
Search for more areas where AI can be implemented.
They're using AI obviously for themselves, for banks, but they're also using AI to to feed its own memory. It's kind of making it stronger. So making the AI in itself stronger. So it's like it learns data as it goes, and then it becomes smarter.
It just sounds like a mathematical model. They're using AI to help out with that.
So it sounds like they're training the AI on trends and patterns, events that have occurred in the past, that the AI can use all this data to give investment suggestions, be a more efficient asset allocation.
That's pretty much it. I guess that I should have mentioned the difference earlier, but that was good.
So, from what Will said, we've understood that banks have been performing well recently, despite an economy that has been haunted by inflation and slowing economic growth rate. But how do the banks do this? How are they generating profit? So, I'm here to tell you that banks can, in fact, take advantage of inflation profits, provided they make the right decision. In fact, when inflation rises, central bank increases interest rate to curb inflation. So banking stocks tend to perform better And this is because the market speculates higher profits for banks. So let me explain why that is. During periods of inflation, the demand for credit increases, and raising interest rate means that people have to now pay back more money to the bank for the credit that they have taken. Now, the gap between what the banks pay the depositors and the money that they earn through lending is how banks make profits. And this gap hasn't been as wide as it is now in the past half century. Even though inflation means that the money that the lenders pay back to the bank is essentially worth less than what it was when they originally borrowed the money, the raised interest rates of the banks help even this out. So this is how banks end up with higher revenues. But I'd also like to point out that it isn't always this black and white. Banking performance have a complex relationship with inflation. If inflation is too high, then it would mean that fewer people will be willing to borrow from banks, which would ultimately mean that banks' revenue would go down instead of up because they're not doing enough business. So let's conclude that the short-term boost in spending in response to high inflation will result in creating some leeway for banks to increase its profits. But if the inflation rises too much, it would be just as bad for banks as it would be for the economy. So let's talk about some banks that recently reported increased profits. So Lloyd's reported a significant jump in their third quarter profits despite a reduction in lending to customers. HSBC, despite concerns about the UK's economic outlook, reported a 240% rise in its latest quarterly profits. Barclays almost doubled its profits to £2 billion in the third quarter. JP Morgan Chase, Goldman Sachs, Bank of America, and Citigroup have also reported high profits.
Yeah, let's keep closing those banks.
So is that because of the bank closures?
Could be, but it could also be related to it's related to a variety of things, not just the bank closure. So these are factors that are contributing towards this high profit that we're seeing.
So the greater interest rates means the banks can take a slightly bigger margin on all the loans and deposits, and it's a really good environment for them. So guys, that's it from us on the Business Boys Bodcast. Today we talked about the banking sector. We gave a brief little history, talked about inflation, interest rates, bank closures, AI, lots of exciting things. So we've seen how banks have increased their profits and hopefully given you a little bit of an insight to where banks might be going in the future. Been joined by Kaf and Hamza, and we've been the Business Boys. Make sure to like, comment, subscribe, and hit that notification bell. Don't forget to do that. And we'll catch you on the next episode of the Business Boys Podcast. Bye for now.